In October of 2008, as the global financial system was collapsing, a quiet message appeared on a small internet forum. Most people never saw it. It was not on television, it was not announced by governments, and it was not reported by major newspapers. This message was posted to a cryptography mailing list, a small online community of programmers, mathematicians, and computer scientists interested in digital security. The person who posted the message used a name that nobody had ever heard before, Satoshi Nakamoto. The message itself was simple. It described a completely new kind of money, a digital currency that would exist entirely on the internet, a currency that would not require banks, a currency that would not rely on governments, a currency that would operate on a decentralized network of computers around the world. In the message, Satoshi wrote a single sentence that would later become famous. "I have been working on a new electronic cash system that is fully peer-to-peer, with no trusted third party." At first glance, the message looked like a technical proposal, but the timing was not random. Just weeks earlier, the global financial system had nearly collapsed. Banks were failing, stock markets were crashing, entire financial institutions were disappearing overnight. Governments were injecting trillions of dollars into the economy in order to prevent total economic collapse. For millions of people watching the crisis unfold, a disturbing realization was beginning to spread. The financial system that most of the world depended on might not be as stable as people believed. Trust in banks was weakening, trust in governments was weakening, and trust in the entire monetary system was beginning to fracture. It was during this exact moment of uncertainty that Bitcoin appeared, but the idea behind Bitcoin did not come from nowhere. It was the result of decades of debate about money, technology, and financial power. To understand why Bitcoin was created, you have to go deeper into the weaknesses of the modern financial system. For most of human history, money had a physical foundation: gold, silver, precious metals that could not easily be created or manipulated. For centuries, currencies were often tied directly to gold reserves. Governments could issue paper money, but that paper could be exchanged for gold. The system created limits. If governments wanted to create more money, they needed more gold. But in the 20th century, that system gradually disappeared. In 1971, the United States ended the final link between the dollar and gold. This moment, known as the Nixon shock, transformed the global financial system. From that point forward, most currencies became fiat money. Fiat money is not backed by physical assets. Instead, it is backed by government authority and public trust. The value of the currency exists because people believe it has value, and because governments declare it legal tender. This system gave central banks enormous power. They could create money. They could influence interest rates. They could expand the money supply in order to stimulate economic growth. Supporters argued that this flexibility helped stabilize economies during recessions. But critics warned that unlimited money creation could eventually create dangerous imbalances. Debt could grow too large, currencies could lose value, and financial systems could become increasingly fragile. By the early 2000s, many economists were already warning that global debt levels were rising rapidly. Banks were lending aggressively, governments were borrowing heavily, and financial markets were becoming increasingly complex. Then the housing bubble began to inflate, and the stage was set for the largest financial crisis in modern history. When the financial crisis erupted in 2008, the scale of the problem shocked the world. Major financial institutions collapsed almost overnight. Investment banks that had existed for more than a century disappeared within days. The most famous example was Lehman Brothers, which filed for bankruptcy in September of 2008. Its collapse triggered panic across global financial markets. Investors rushed to sell assets. Stock markets plunged. Banks stopped lending to each other. Credit markets froze. The global economy suddenly faced the possibility of a complete financial meltdown. Governments around the world realized they had two options: allow the system to collapse, or intervene on an unprecedented scale. They chose intervention. Central banks began creating enormous amounts of money. Interest rates were pushed close to zero. Governments injected capital into failing banks. Financial institutions that had taken enormous risks were rescued in order to stabilize the system. Supporters argued that these actions prevented a deeper economic disaster. But for many observers, the crisis revealed something disturbing. The system appeared to protect large financial institutions. While ordinary people carried the consequences, millions of families lost their homes during the housing collapse. Unemployment surged, savings disappeared. Yet many of the institutions responsible for the crisis survived with government support. Public trust in the financial system began to erode. And this loss of trust created fertile ground for a radical new idea, a form of money that did not rely on banks or governments at all. Bitcoin introduced a concept that had never been implemented at global scale before: decentralized money. Instead of relying on a central authority, Bitcoin operates on a network of computers distributed around the world. These computers verify transactions through a process called mining. Transactions are grouped into blocks. These blocks are added to a public ledger known as the blockchain. The blockchain records every transaction that has ever occurred on the network. And once transactions are recorded, they're extremely difficult to alter. This creates a system where trust does not depend on institutions. Instead, trust emerges from mathematics and cryptographic verification. But Bitcoin introduced another critical feature: scarcity. Unlike traditional currencies, which central banks can create in unlimited quantities, Bitcoin has a fixed supply. Only 21 million coins will ever exist. This rule is written directly into the software. It cannot easily be changed. This design was intentional. It created a form of digital money that behaved more like gold than traditional currency. Gold is valuable, partly because it is scarce. Bitcoin was designed to replicate that scarcity in digital form. For the first time in history, people had access to a currency that could not be inflated by governments, and that idea began attracting attention. In the early years, Bitcoin was almost unknown. In 2009 and 2010, very few people used it. The value of a single Bitcoin was only a few cents. Early adopters were mostly programmers and technology enthusiasts. They saw Bitcoin as a fascinating experiment in decentralized systems. But slowly, the network began growing. Developers improved the technology. Online communities formed around the idea. New companies began building services that allowed people to buy and store Bitcoin. Then, something unexpected happened. The price began rising. As demand increased, Bitcoin attracted attention from investors. Some saw it as a new form of digital gold. Others saw it as a hedge against inflation. Still others saw it as a revolutionary financial technology. By the late 2010s, Bitcoin had transformed from a niche experiment into a global financial asset. Institutional investors began entering the market. Large companies started holding Bitcoin on their balance sheets, and governments began debating how to regulate it. What began as a small idea posted on an obscure mailing list had grown into a multi-trillion-dollar financial phenomenon. The rise of Bitcoin raises a deeper question. What is money? For centuries, money has evolved alongside technology and economic systems. Gold replaced barter, paper currency replaced gold, digital banking replaced physical cash for many transactions. Bitcoin represents the next possible step in that evolution, a form of money native to the internet. A currency designed to operate globally without central control. Supporters argue that Bitcoin could become a new form of financial infrastructure. Critics argue that it remains too volatile and speculative to replace traditional systems. But regardless of the debate, Bitcoin has already changed the conversation about money. It has forced governments, banks, and economists to reconsider the foundations of the financial system. And it has introduced the possibility that money itself may evolve into something entirely new. Closing Bitcoin did not appear randomly. It was born during a moment of financial crisis, a response to collapsing banks, a response to expanding debt, and a response to growing distrust in centralized financial power. Whether Bitcoin becomes the future of money remains uncertain. But one thing is clear. The world is now questioning the systems that control money, and once those questions begin, the financial system can never look the same again.